Welcome to this explainer. Okay, let's dive right into a seriously fascinating Wall Street mystery today. We aren't looking at some ordinary, publicly traded stock here, but rather high-stakes credit risk story that basically has the entire financial world talking. It's one of those rare situations that forces us to look past the surface and figure out what on earth the market is signaling when the numbers suddenly stop making sense. Our investigation kicks off with a massive $1.18 billion loan. This is definitely not small change. It was issued by GIH Borrower LLC, which is a financing entity connected with Guggenheim Investments, a massive player in asset management. Now, this loan isn't due tomorrow or even next year. It doesn't actually mature until 2031. So on paper, at least, we're looking at a massive obligation with a very, very long runway.
And honestly, until recently, everything seemed perfectly fine. The market was totally willing to value this massive loan at a very healthy 96 cents on the dollar. In the credit world, 96 cents means investors are feeling confident. They're basically saying, yep, we believe we're going to get our money back. It's essentially trading at par, which reflects solid stability and a lot of trust in the borrower's ability to actually pay.
But then, the floor just completely fell out. The debt's market price collapsed to roughly 73 cents. That is a brutal 24% decline in a super short window of time. Debt maturing in 2031 doesn't just drop 24% overnight without some massive catalyst, right? This isn't a stock reacting to a bad tweet. This is a credit instrument screaming that the underlying risk is fundamentally changed. To put that percentage drop into perspective for a second, the implied market value plunged from $1.113 billion down to roughly $861 million. That means about $272 million in value was completely wiped out. It just evaporated into thin air. For the lenders holding this paper, that is an absolutely catastrophic repricing of their assets.
So obviously we have to ask the most important question in finance. What exactly changed? Because the maturity date didn't suddenly jump from 2031 to tomorrow. The mechanical timeline of the loan is exactly the same, and the cash isn't due any sooner. So we've got to follow the money, look at the underlying business, and figure out what spooked the market so severely. Well, the clues are buried in the Q2 earnings report. Revenue definitely took a hit, a 38% drop down to $186 million. But that was completely overshadowed by a staggering 77% collapse in an earnings measure, which plummeted to just $37 million. Now, sure, a company can usually survive a dip in revenue, but when earnings fall dramatically faster than revenue, that means the fundamental economics running underneath the business are shifting, and not in a good way. This creates a really sharp divide in how you can read this data. A beginner investor might just look at a 77% drop and panic, but professionals interrogate the data. We basically have two competing views here. Interpretation A, which is management's view, suggests this is just a temporary accounting timing issue related to when they recognize advisory fee revenue. But interpretation B is the market's biggest fear, that this represents a much deeper, systemic deterioration of the underlying economics.
And adding fuel to that pessimistic view is the broader news environment. While Guggenheim's chief investment officer, Ann Walsh, strongly defended their accounting treatment of these private investment advisory fees and emphasized their cooperation, we've seen reports from Reuters and Bloomberg about probes from U.S. regulators and federal prosecutors. Now, an investigation is definitely not a conviction, but it does create the ultimate penalty in credit markets, pure, unadulterated uncertainty.
This perfectly illustrates how credit markets actually communicate that uncertainty. Pricing the loan down at 73 to 77 cents isn't a crystal ball guaranteeing a default, but it is a severe risk signal. The market is effectively saying, look, I am not willing to pay a full dollar for a claim that promises a dollar. I demand a substantial discount for taking on all this uncertainty.
Section 1. The affiliate buyback twist.
Right in the middle of this massive price drop, we get a wild plot twist. Guggenheim announced its affiliates might actually step in and purchase portions of this exact loan in the open market. And honestly, the math behind this move is incredibly compelling. If an affiliate buys this debt at, let's say, 75 cents and simply holds it until maturity in 2031, they get the full dollar back. Mathematically, that generates a massive 33.3% potential price appreciation, and that's completely separate from any interest they collect along the way. If management truly believes the core business is fine, this is a highly rational, highly profitable trade.
But there is a critical detail here that is so easy to miss. If the borrower itself bought and canceled the debt, the liability would just magically disappear. But if an affiliate buys and holds the debt as an investment, the obligation still exists. The lender simply changes, which raises a really fascinating question. Is this affiliate purchase a genuine vote of confidence in the underlying company, Or is it just a separate arm of the empire taking advantage of distressed pricing for its own gain?
Because Guggenheim Investments is part of a much larger $367 billion organization linked to Mark Walter, sophisticated investors know they have to look past the basic corporate relationships. They have to intensely scrutinize these specific governance and structural risks. Shared ownership doesn't mean shared legal liability. You really have to dig into conflicts of interest, related party transactions, and exactly how strong the creditor protections actually are on this specific piece of debt.
Section 2. The private credit warning. Zooming out from this one specific loan for a second, this whole saga serves as a giant warning light for a major structural quirk in the booming private credit industry: price discovery. Unlike a public stock that trades thousands of times a day and gives you constant feedback, private loans don't have continuous liquidity. Their prices can remain totally opaque for long stretches. So when bad news finally forces price discovery, the loan doesn't just slowly tick down from 96 to 95 to 94, it gaps down. That sudden, violent repricing to 73 cents can be absolutely brutal and catch investors totally off guard.
Section 3. The verdict: bull versus bear.
Piecing this all together, we arrive at two dueling professional investment arguments for this high-risk asset. The bull case relies heavily on time and math. You've got a long runway to 2031, strong affiliate demand, a really firm defense of the accounting practices, and a mathematical upside of nearly 37% if it recovers to par. The bear case, on the other hand, focuses squarely on the reality right now. A devastating 77% earnings drop, looming regulatory probes, deep governance complexities, and severe information asymmetry. Basically meaning the insiders know exactly what's going on and you don't. If you're tracking the fallout of this in the real world, you absolutely must watch these 5 metrics. First, keep an eye on the loan price trajectory. Does it trend back toward 100 or drop toward 50? Second and third, watch for revenue and earnings recovery in the upcoming quarters. Fourth, pay special attention to the Financial Times reporting of $165 million in expected 2026 revenue for private investments, especially since there is zero guidance provided for 2027. And finally, watch the regulatory outcome. Honestly, that will probably trump every other metric on this list. Ultimately, we leave you with the true investment mystery to ponder. The question isn't simply, is this cheap? The real question for anyone looking at private credit is this: is the massive discount on this billion-dollar loan large enough to justify the sheer amount of accounting, governance, and regulatory uncertainty you have to swallow? Thanks for joining me on this explainer, and remember to keep your eyes on the data.